Are we witnessing the calm before a market storm?
Renowned experts like Danielle DiMartino Booth and George Gammon are here to share their critical analyses.
And what's the best part? You'll receive all the essential points in just minutes.
Exactly. Discover insights on why interest rates are spiking and how that could reshape the market landscape.
Welcome to Financial Insights in Minutes, where we distill complex financial data into actionable intelligence.
Stay tuned as we delve into pressing topics, including the latest CPI data and its implications for consumer spending.
But first, let's hear from the esteemed Danielle DiMartino Booth as she discusses the troubling trends in consumer health. Today, we're diving into a crucial analysis by Danielle DiMartino Booth about the troubling disconnect in consumer confidence and economic realities.
Absolutely. Let's unpack the narrative the media has been shaping around our economy.
Danielle's core message revolves around a crucial question: is the economy truly doing well?
Based on her analysis, it's less about optimism and more about overlooking significant economic challenges.
What's driving this divergence between public perception and economic data?
She highlights a pattern of misleading media narratives downplaying negative economic signals.
The latest poll reveals that just 25% consider economic conditions as good. What's causing this skepticism?
DiMartino Booth attributes this to the reality many face versus the media's upbeat portrayal.
The GDP figures seem disappointing. How did Danielle interpret them?
She underscores that the media spins unfavorable numbers to find a silver lining instead of facing hard truths.
Consumer spending is supposedly up, but what's the catch?
Danielle points to a troubling debt trend. Americans are spending more but falling deeper into financial holes.
What about the job market? Are layoffs becoming a norm?
Yes, Danielle highlights a significant number of layoffs, contradicting any media narrative of robust job growth.
With all this talk of market corrections, what does Danielle predict?
She warns that if corrections occur, consumer confidence levels could plummet even further.
Danielle forecasts a significant market correction ahead. How did she arrive at this?
She believes that the current spending bubble can't endure. If it bursts, many are unprepared.
What might happen to consumer spending if economic conditions decline?
Danielle implies a downturn could lead to severe cutbacks in spending. People will tighten belts.
As we wrap up, what are the key takeaways from Danielle's insights?
It's clear. Understanding economic realities is critical for preparation, especially with media narratives often misrepresenting the truth.
Absolutely. Staying informed could be the key to navigating financial uncertainties.
Indeed, we must be vigilant and not get lost in overly optimistic headlines.
Today, we're breaking down a fresh analysis by George Gammon on why interest rates are skyrocketing. Buckle up.
Perfect. It's a critical topic right now with so many moving pieces in the economy.
What's the core argument George is making about interest rates?
He suggests that rates are more about broader economic growth and inflation than about treasury supply.
Let's talk numbers. George mentions mortgage rates now over 7. That's a big jump.
Indeed, this increase is equivalent to a significant rise in home prices from a payment perspective.
What does George believe drives interest rates?
Primarily growth and inflation expectations rather than just treasury supply, which is quite a revelation.
Discussing inflation, George notes a sharp rise over recent years. What's driving that?
He links it back to massive increases in the money supply and pandemic-related spending.
What are the predictions George makes about future interest rates?
He indicates a strong likelihood that we might see the 10-year Treasury yield drop significantly to around 3%.
So, moving on to predictions. What's the forecast for the 10-year Treasury yield?
George forecasts that growth and inflation expectations will lower, potentially dropping yields to 3%.
To wrap this up, what key takeaway should viewers have about interest rates?
The core message is clear. Interest rates will likely reflect growth and inflation expectations moving forward.
On this spooky Halloween, the markets are haunting investors with a significant sell-off. What's the scoop, Gary Wagner?
Indeed, it's quite a fright. Markets are reacting to various geopolitical and economic factors.
Can you pinpoint the main causes behind today's market declines?
Absolutely. The sell-off largely stems from profit-taking and the impact of inflation data.
So gold is facing a setback today. Is that indicative of a larger trend?
I believe this is just a transient dip. Gold remains strongly positioned for growth.
The market seems to be in a panic. What's triggering such drastic reactions?
Market sentiment can shift quickly. Profit-taking often exacerbates these dips.
Let's dive into the gold market. What's your prediction?
I'm forecasting a rise to $2,865, backed by strong fundamentals and increasing gold acquisition from central banks.
How are current geopolitical tensions influencing gold prices?
Geopolitical conflicts create safe haven demand for gold, which generally rises during such crises.
With inflation data showing mixed signals, why doesn't the market react positively?
Markets can be fickle, often misunderstanding the implications of economic indicators.
What's in store for gold pricing moving ahead?
I foresee it possibly hitting $3,000, especially with ongoing geopolitical issues.
With the election looming, will markets react differently based on outcomes?
Absolutely, regardless of who wins, we could see significant volatility in the markets.
Ultimately, what should investors take away from your analysis?
Stay vigilant. The market may present both risks and prospects as we head toward year-end.
Today, we're diving into some alarming reports from Eurodollar University. Let's look at the state of the labor market.
Yes, income growth is slowing, and it seems major indicators are just beginning to wave red flags.
So what's really going on with personal income?
The latest statistics reveal alarming trends. Income growth is slipping into recession territory.
And that impacts consumer spending significantly, right?
Exactly, it's a cycle. Slow incomes lead to cautious consumers.
First up, let's talk shrinking incomes. What's the latest data showing?
The numbers are troubling. Personal income growth has slumped to just 1.9%.
How is this affecting consumer spending, especially for big purchases?
Consumers are hesitant, which is evident in auto sales. Dealerships are overwhelmed with inventory.
The auto industry is evidently feeling the pinch. What happened with Ford and Stellantis?
Both reported disappointing sales figures, confirming that the economy isn't as robust as forecasted.
And what's happening with job openings? Are we seeing companies hire?
Hiring is flat, and companies are cutting jobs, clearly a worrying sign.
Given all this, what are the predictions for the near future?
Expect continued economic pressure as personal income stagnation propels recession fears.
What does this mean for consumer confidence moving forward?
It's set to take another hit, pushing spending deeper into caution.
So it sounds like automakers like Stellantis will be in a tough spot.
Definitely. With consumers wary of spending, those unsold cars will pile higher.
In summary, how bleak is the outlook for our job market?
It's concerning. Without decisive action, we could see serious economic implications.
Keeping a close eye on these trends will be critical moving forward.
Absolutely. The future seems unpredictable as income stagnation continues to creep in.
We're live with a pre-market prep discussing the critical labor report that's about to drop.
Absolutely. This could really set the tone for the market today. The labor numbers are crucial.
What are we anticipating from the job growth figures about to be released?
Analysts are bracing for a decline in job additions. There's real concern about how that will affect market momentum.
It's like watching a game where the stakes are incredibly high.
Exactly. A weak report could lead to a significant market reaction.
So what's the consensus on job growth today?
Economists are predicting the slowest pace of hiring in years. It's not looking encouraging.
And the unemployment rate? What's the outlook?
It's expected to remain below 4.3%, which could provide some limit to the negativity.
How could a strong reading shift expectations?
It might prevent the Fed from cutting rates further, adding to market jitters.
And depending on the data, we could see big market shifts today.
Absolutely. Employment figures are definitely the catalyst we're watching closely.
To wrap it all up, what's the main takeaway for traders today?
Expect volatility based on the labor report. Be ready to adapt your strategies.
Today, we uncovered insights from our fantastic guests regarding the precarious state of the economy.
Absolutely. Danielle DiMartino Booth highlighted the disconnect in consumer sentiment compared to media narratives.
And George Gammon's take on interest rates really pointed out how those expectations could sway yields significantly.
Plus, Gary Wagner's bullish stance on gold shows there's still hope amidst market volatility.
Great points. But we also need to heed the warning from Eurodollar University about the slowdown in personal incomes.
Indeed. It's critical for viewers to analyze these varying perspectives to make informed investment decisions.
If you found value in today's discussion, remember to give us a like and subscribe for more financial insights.
And don't forget to check out our other content for continuous updates on these pivotal topics.
Thanks for watching, and we'll see you next time on Financial Insights in Minutes.